Good afternoon. Thank you for joining us for this webinar, Business Valuation, What is a Business Worth? I am your moderator, Renee Goodnow from the New York Small Business Development Center. Today's webinar host is the Pace Small Business Development Center. The Pace SBDC is part of the New York SBDC's network of 22 campus-based centers and outreach offices located across New York State. We are a U.S. Small Business Administration resource partner. Our free service is made possible by funding from the SBA, New York State, and our host campuses. Joining us today to lead things off and to introduce our presenter is Pace SBDC Director Andrew Flam. Andrew, I will turn things over to you.
Terrific. Thanks so much, Renee, and good afternoon, everybody. Again, my name is Andrew Flam. I'm the Regional Director of the Pace University SBDC, and so pleased you all can join us today for our session on business valuation. And I'm delighted I'll be introducing my colleague, Marcus Braga-Alves from Pace University in just a moment. I wanted to sort of briefly reference kind of who we are, what we do, and hopefully how we can help you. And I will be adding a couple of links into the chat in a moment to provide you some further detail. First off, as Renee had mentioned, our center is one of 22 throughout the state offering no-cost business advisement to both existing business owners as well as aspiring entrepreneurs. So we are all staffed by a team of full-time business advisors, and what they do day in and day out is working with entrepreneurs such as yourselves in terms of helping them build, expand, and launch small businesses here in New York State. So those issue areas typically revolve around access to financing. So looking to help businesses figure out how to, secure financing either for growth opportunities, whether it's to secure longer-term, lower-interest finance, might be access to some of the key COVID recovery-related programs. So really looking at kind of what those best fits are for you, your business, and thinking about how to kind of make it part of your sustainable model. Also the prospect, of course, of business purchase, sort of thinking about, long-term investment like that and being able to tie into today's topic, regarding business valuation. Other issue areas our business advisors typically get involved in is marketing and sales guidance and support, whether it's building or expanding a website, looking at e-commerce, putting together a social media campaign. These are kind of key components of what our business advisors work on a day-in, day-out basis. Also looking at operational challenges you may be having, access to procurement opportunities. In fact, on Wednesday, where our center is hosting a session with the Small Business Administration on government procurement and certification opportunities. So if that strikes a chord, certainly feel free to join us for that as well. But looking at kind of how to help your business take advantage of opportunities out there like that, thinking about what might be a good fit for you based on your industry, based on your capacity, and then thinking about how we can kind of build that capacity through developing capability statements and securing contract financing and other methodologies. So again, these are the things that our business advisors do day in and day out, and we'd be more than happy to have them connect with you. And I'll put a link in the chat so you can find out how to connect and arrange a one-on-one business advisory session. Again, all offered at no cost. So whether you're in New York City, where we're located, or if you're joining us from other parts of the state, you'll be able to get connected with the SBDC that's most convenient for you. Today's session is also an example of the kind of training that our center and our colleagues throughout the state offer on a day-in and day-out basis, often digging more deeply into a specific topic where we invite a key industry expert. We'll kind of go more in depth into that topic and help you understand kind of generalities and understand how that may impact your business. And ultimately, what we'd love to do is take the things that you've learned today and help us kind of guide you in terms of a one-on-one session with a business advisor as a follow-up step. So again, if that's of interest and would be helpful to you, I'll stick my contact info in the chat so you can kind of get in contact with us and go from there. I guess other issue areas I'll kind of touch on again sort of finally is making sure in terms of COVID recovery programs, there are a wide range of resources out there. It's not the topic of today's discussion, but to make sure that you're aware of all the various public and private resources that are in place to help small businesses with the challenges that have been in place, this nearly 2-year period. Please do look through the link that I'll send over to you that has access to information about the various programs that are in place. If you have questions about them, want to sort of explore whether your business may be eligible, or have questions about applications you submitted, do reach out to us and see if we can help as well. So that's kind of a brief overview of kind of who we are, what we do as a network. And for those of you working with already, we're delighted to continue. And for those who are joining us for the first time, certainly look forward to kind of working with you all longer term. So with that, I'm going to turn the floor over to my colleague, Marcus Braga-Alves. He's an associate professor of finance at Pace University and a terrific guy and a neighbor downtown. So Marcus, I'm going to turn it over to you. And again, really thank you very much for joining us today and leading this discussion. Marcus, it's all yours.
Thank you, Andrew, and thank you, Rene. I'm a finance professor, and I'm going to start saying something here that usually gets me in trouble, but I do this to motivate the discussion, to make everybody even more interesting. And what I believe that's the most important thing in a business, it's money, right? And this is what gets me in trouble, because if I have a marketing professor here in this presentation, the marketing professor is going to say that's not the most important part of a business. If I have a human resources professor, the professor is going to tell me that money is not the most important part of the business. But I say that it is because, first, it is one of the most important parts of a business. And second, because this creates big discussion around what is the most important part of a business, right? And this is our topic that we're going to discuss today. Then why should we be interested in knowing what determines a business value? There are many reasons why. One is because when you know what determines your business value, you know what determines your business growth. And this is something that everybody wants, right? You want your business to grow. Another reason why you would like to know what determines a business value is because your bank manager would ask you this. Your bank manager is going to ask you what your business value is when you apply for loans. Definitely, you need to know your business value when you're selling your business. But again, this is not the only instances when you need to know your value, your business value. The most important reason, in my opinion, is that you need to understand what determines your business value, because during the daily life of a business, you need to focus on these determinants. You need to know exactly what's going to affect the bottom line of your business, the profitability of business, the growth of your business, the credit worthiness of your business. I want to make this presentation as interactive as possible. Therefore, please feel free to ask questions at any time. We can stop, answer the questions, come back to the presentation. That would be great if we can do that. Okay, then let's talk about the first methodology that we can use to assess a business value. We know that assets are things that a business owns. Liabilities are things that the business owes. The value of a business may be defined as the difference between assets and liabilities. A business assets can be found in the balance sheet of a business. On the left-hand side of the balance sheet. There, they're reported by their book value minus the depreciation. Depreciation accounts for the use of the asset. The longer that you use an asset, the lower its value. What we need to do when we want to figure out the value of a business is to use the market value of the assets. The market value of the assets represent what you can get if you decide to sell your assets. Again, I'm not saying that you're going to define the market value when you're selling your assets, but you need to know what the market value is, even if you're not planning to sell your business. We have to account here for the fact that we have some intangible assets that are not included in the balance sheet. Intangible assets, they do not have a physical presence when they are, and they are not reported in the balance sheet when they are internally generated by your business. Therefore, we need to take this in consideration when you calculate a business value. Liabilities are usually easier to take in consideration. They usually are not reassessed in this analysis. Here we have a very simple example of how we can use assets and liabilities to estimate a business value. Suppose that the market value of your business is $400,000. Your business is very well respected in your community. You have a list of 500 loyal customers, emails and addresses. Your clientele is very well known by yourself. It's very loyal, and therefore this means that your earnings are less volatile than otherwise. Liability add up to $35,000. In this simple method to calculate your business value, you would subtract liability from your assets. Here you subtract $35,000 from $400,000, you get $365,000. But what about this list of emails and addresses? How much is this worth? Definitely, you realize that this has some value. And this is not reflected in this simple calculation. This is what I was talking about when I said that you have to analyze intangible assets and how intangible assets are going to affect your analysis. You need to understand how much value this intangible asset can bring to your business. If you're selling your business, this is going to be part of your discussion with the potential buyer. If you are not selling your business, it's going to be more difficult to value this list, but you need to know that there is a value there. Even if you don't know exactly what the value is, you need to understand that if you cultivate a loyal customer base, you're going to be adding value to your business. This is why we're having this discussion today, to learn what things you can do in the regular daily lives of your business to add value to it. Here, we're going to have a short break. Let's see if you can think about these questions and tell me what the answers would be. How does liability affect a business value? Would anybody be willing here to give us an answer? Okay, we saw that liability, higher liability is going to reduce your business value. This is very simple, right? We start with questions and then we start asking questions that are more difficult. The second one is a little bit more difficult than the first one. What type of firms would this method, asset minus liability, be a better fit?
We did get a message in. Small amount of cash and savings, less large amount of loans.
Okay. Anybody else?
Retail manufacturing was one
Yes.
comment.
Exactly. Exactly. If you have a service business, this method is not going to be the best method to assess your business value, right? Because a service business does not usually have many assets, relatively speaking, when compared to manufacturing business. Then a service business would be better valued by using another methodology. Like, for example, the seller's discretionary earnings methodology, or SDE. The SDE focus on the business profitability and cash flow. What we are going to do first here is to take the annual income of your business and add back a few things that are either not very closely related to your business or not easily managed by the owner, or actually they are completely decided by the owner. What you are looking for here are factors directly related to cash flow that are closely related to the business. Then we are going to take the annual income and add back taxes, non-cash expenses, because we want to focus on the cash flow. Non-cash expenses would be depreciation, for example. Non-operating expenses, expenses that are not closely related to the operations, like interest payment on loans. We would also add back one-time expenses that are not regularly paid by the business. And we would add back owner's salary because this is determined by the owner, and different owners have different needs and definitions of their compensation. To calculate the value of a business based on SDE is very simple, because there is information out there about what we call a cash flow multiple. A cash flow multiple would be the value of other business divided by the cash flows that they generate. These multiples, they are available on the web. Here I provide a link that you can click later and see these multiples there. But you're going to see an example about how we can use these multiples to value a business. Before we go to the example, I want to highlight here that to use this methodology, we need to be very careful when we prepare our financial statements. We need to make sure that we record our revenues and expenses correctly. Good financial statements are extremely important for methodologies that rely on them to give you your business value. Now, suppose that your income statement shows that you have a net profit of $150,000. If you add back personal, discretionary, one-time expenses, and owner's salary, your business SDE would be $217,500. The table that you're going to have, if you click on that link now, is related to 2021. when I prepared the slides, the table was giving us information about 2020. I went to that table to prepare the slide and check what the multiple would be for New York City in 2020. That multiple was 2.17. I multiplied this multiple times the SDE, and I find that the market value would be $471,975. If you go there on that website today, you're going to have a different multiple because that multiple is related to 2021 now. Okay, have our next questions. The first thing that I would like to ask you is to think about factors that would increase a business SDE. What do you think that would help you to increase the business SDE and consequently the business value?
There was a comment that came in for goodwill, higher cash flow.
Higher cash flow, yes, higher cash flow. And how would you increase your cash flow? Very simple things. Think about the net income, right? Because we started with the net income and you added back things that are not directly influenced by the business itself. What are the things that are related to the business? Sales, for example, right? If you sell more, you're going to increase your SDE. Then you have to think about strategies to increase your sales. What strategies could increase your sales? Think about your own business.
Less loan payments, or less in loan payments, rather.
Yes, this is very interesting, but you have to remember that to calculate the SDE, we add back interest on loans because we do not want to consider things that are not closely related to the business, to the operations. Loans are related to the way that we finance our business. Here, we want to consider only, in this specific method, only things related to the business itself. Doesn't matter how you're going to finance your business. If you're going to finance with your own money or if you're going to finance with loans. We want to think about things that are related to your operations. Sales, increase sales. You're going to increase sales. Like, for example, during the pandemic, many people went online, right? They created their own websites. They were not selling products or providing services via the web. Now they are. They're increasing their sales. The other side here in this equation is to reduce your costs. Every time that you are spending money related to your operations, you need to think about how you can do this more efficiently. Efficiency is related to things that you can do better, more, with less money. Okay, and this is
other comments in for you too. Let me know when you want me to read them.
Yes, please, Renee.
Hire employees, increase marketing, increase sales and expenses, expansion into different markets, hope that the increased sales is greater than expenses, scaling the business to increase sales, and diversifying your customer base.
Yes, that's excellent. Excellent. I had a conversation with a professor who used to work on Wall Street, and he said that the sales personnel, they were the most important employees in a company. And I agree with him. If you invest in your sales team, you probably are going to have higher sales. I agree 100%. And what type of characteristics would affect a business multiple? You saw that when I provided you the information about the multiple that I used in our example, I mentioned New York City, right? Different locations, different geographic locations, they have different multiples for the same business. If you go to the link that I provide to you, you're going to see that they list the multiples for different geographic regions. What would be a different characteristic that would affect a business multiple?
We didn't get any yet on this one, but on the last one, somebody did share efficiency measurements. I wanted to make sure I didn't miss that one.
Yes, thank you, Renee. That's very important. Yeah, efficiency is something that you have to keep in mind every time that you are writing a check or paying a bill. You should always be thinking how I can do this better, get more for my money. Okay, that's very important.
For this one, type of business, use of technology, patents, whether they have a pandemic-proof business, ease of replicating the business increases the multiple, being a monopoly affects a multiple, population and demographics.
Yes, population demographics would be related to geographic location, and the other factors mentioned by Renee are related to the industry of your business, right? Different industries have different multiples. Then restaurants are going to have multiples that are different from theater. Then you have different multiples for different industries as well. Thank you very much. Now, if we work backwards, we can know how we can get a higher market value for our business. Then in this example here, suppose that you want to sell your business for $600,000. What would be the SDE that would give you this $600,000? To find the market value of your business, we multiplied the SDE times the multiple. Now, the multiple is provided. You go to different websites, you're going to have the multiples there, right? The multiples are usually the median of sales by cash flows divided by cash flows for different regions, for different industries. You want to find a specific market value. Therefore, what you have to solve for is the SDE. Then if you have a target market value of $600,000 and the multiple is 2.17, your SDE should be $276,497.70. Now you need to figure out how you're going to increase your SDE. In this example, your SDE was $217,500. If you want to increase the value of your business to $600,000, you need to increase your SDE to $276,497.70. Here, the next step would be to think about different things that could add to your SDE. We talked about that in the previous slide. You could invest in your sales team. You could increase your efficiency, produce the same thing or more with lower costs. Things like that would improve your market value, your business market value. And here is exactly the goal of your presentation, to think about specific things that you can do to increase the market value of your business. We have different business represented here today. You are the experts on your own business. Then we are not going to be able to cover everybody's business today, but after this presentation, your homework would be have lunch thinking about what you could do to increase the value of your business, how you can increase sales, how you can reduce costs.
Marcus, do you have a website that folks could go to get the multiple?
Yes. If you click here in this link, you're going to see the multiples for 2021 for different geographic regions and for different industries. Before we start talking about the next methodology, I just want to go over a simple example of an income statement. Okay, an income statement is represented by the revenue. If you subtract costs, you're going to have what we call earnings before interest, taxes, depreciation, and amortization. If you subtract depreciation and sales, general and administrative expenses, we have what we call earnings before interest and taxes. If you subtract interest, we get earnings before taxes. And if we subtract taxes, we're going to get net income. I know that your income statement is probably more complex than this, but this gives us exactly the definitions of these variables that are going to need for the next methodology. Now in yellow here, I just want to show this is usually the case for companies that have shares traded in public markets like the New York Stock Exchange, NASDAQ, but can be used for small business as well. We have earnings per share defined as net income divided by shares outstanding. If you are the only owner of your business, your earnings per share is equal to your net income.
There was a question on the last slide. Why is the sales something to be subtracted? Why is that different from earnings?
Yes, sales in this case are expenses. I should have added here. I'm going to make this clear next time. It's sales, general, and administrative expenses. Now, the next methodology that we are going to discuss is called comparables. Okay, comparables try to standardize different measures of a company's value to allow us to compare these measures within an industry, within a sector. In this case here, we're going to use two comparables. There are many others, but since we have limited time here, I'm going to focus on two of the most popular comparables. Price to earnings, or PE ratio, is the price per share, or if you are the only owner of your business, is the value of your business, market value, divided by earnings per share. Again, if you are the only owner of your business, this would be the net income. P ratio is price divided by earnings per share. The enterprise value uses the whole value of the company, not only the value of the equity, right? As in the first case would be the value of your equity. In the second example would be the value of the entire company. Then you would take the market value of equity plus the market value of debt minus cash, because nobody is going to buy cash if they are buying your company. They're going to pay in cash. And they divide the market value of the company by earnings before interest, taxes, depreciation, and amortization. Because we are interested in a measure of profitability here that is directly related to your operations. And this measure is called the enterprise value ratio. The enterprise value ratio has some advantages over the PE ratio. For example, as I said, when you are interested in your operations, you exclude things related to the way that you finance your business. You want to know how you're going to improve your sales, you're going to reduce your costs. Of course, the way that you finance your business is important, but not at this time, not for this discussion. In this example here, if a close competitor business was sold for $200,000, your business is probably worth $200,000 if you have the same size, similar location, similar clientele, but this is not usually the case. Businesses are different. Then these comparables, they standardize, they make this business similar to allow us to compare their values. Let's see an example here.
How does the comparables methodology work when taking into consideration intangible assets?
This is a very good question. It's a very good question. We go back to the first example that we had. If the intangible asset is not included in your analysis, and you believe that this should be included, you have to add to the market value of your company if you're talking about the enterprise value ratio, or to the market value of your equity if you're talking about the P ratio. It's a very good question. These valuation methodologies, they give you the beginning of the discussion. Every single business is different, and you have to know your business, know the intangibles, know any problems that you may have in your business. You have to include this in your analysis. Okay, that's a very good question. Thank you, Rene. Now, in this example, we have two companies that reported annual earnings equal to $200,000. One company is selling for $500,000. The other company is selling for $475,000. If you calculate the P ratio, let's assume that this would be the best methodology to use in this case. We would have that the first company has a P ratio of 2.5, and the second company has a P ratio of 2.375. But these are similar companies. We're standardizing these values by the earnings of these companies. Why do we have different P ratios? What would you think? There are many answers here. One could be that the goodbye company is undervalued, right? That could be the case. For many different reasons, this company may be selling for $475,000, while it should be selling for $500,000. Or the hello company is overvalued, should be selling for $475,000. It could be either one or the other. The hello company.
We got a comment that different locations and cost of goods sold.
Yes, exactly. You have to take into consideration location, the industry. Companies from different industries are going to have different P ratios from different locations. They are going to have different P ratios. Growth, companies that are expected to grow faster, they're going to have higher P ratios. Then you have to understand this to use this methodology. We standardize the value of the company by earnings, but earnings do not represent all the different factors that determine the value of the company. Then we need to compare apples to apples when you use the P ratio or similar comparables. Now, two more questions. What are the advantages of the enterprise value ratio over the P ratio?
While those are coming in, there was a question. Did your accountant develop these statements?
Yes, and that actually is one of the points of this presentation. We are going to see this in the next slides, that yes, your accountant should be preparing these statements, and you should understand these statements. If you do not understand, you should learn how to read these statements. Okay? I know that it may seem very difficult, but they are not. Once you get used to them, you're going to do this on a regular basis very easily. Okay? You should be checking these statements regularly. We're going to talk more about this in the next slides.
Thank you. And then we got one in on this question, enterprise value for service biz.
Yeah.
Yeah, the enterprise value takes into consideration your funding, adding value.
Yes, this is a very good point. Okay, and see how you're bringing these factors that affect valuation to our discussion. See how you already understood that these things should be the ones that you're going to think from now on a regular basis. It's not going to be only for this presentation. It's going to be also for your daily lives now. These are your own business. These are your babies, right? You want them to grow, to be successful. And as I said in the beginning of the presentation, there are many things that you can do to guarantee the success of your business. You can invest in marketing, you can invest in training, but at the end, what you're going to be looking for is that number at the bottom of your income statement. And by the way, this answers our second question, right? What can you do to increase your business value? Now we're going to get a little bit more technical. And I know that this may sound very complicated, but these are new things that you can learn, right? You do not need to be an expert on that, but you need to understand the concepts in order to incorporate them in your management. Now, the time value of money. We know that if you receive $1,000 next month, you cannot compare this $1,000 in nominal terms with $1,000 that you have today in your pocket. In your business, this comparison gets even more complicated because we're not talking about a 1 month difference. You are going to have cash flows coming years from now. And these cash flows, they have a different time value. Cash flows that you receive sooner, they have a higher time value, even when they have a similar nominal amount. $100,000 today is much more valuable than $100,000 10 years from now. We calculate the present value, the value today of a cash flow that you are going to receive in the future, using this equation that we have here on this slide. PV is the present value. FCF is free cash flow. R is the discount rate. We're going to see what this is in a few minutes. And time is the time between today and when you expect to receive this money. Then if you use this equation, you can calculate how much $100,000 that you expect to receive 10 years from now should be worth today. And once you brought all these cash flows that you expect to receive in the future to the same point in time, you can add them, right? And if you calculate these cash flows and add them, you have the value of your business. If you add the present value of these cash flows, you have the value of your business, okay? Again, it may sound complicated if this is the first time that you're seeing this, but it's just a matter of bookkeeping, trust me, okay? Now, we have two different ways to calculate the value of your business. We can calculate the entire value of your business or the value of the equity of your business. We have been talking about equity since the beginning, right? Equity is assets minus liability. The value of your whole business includes everything, includes equity and liability. Now, if you want to calculate the entire value of your business, you're going to use the free cash flow available to the firm. We're going to call this FCFF. And the discount rate, the R that I told you about in the previous slide, is going to be what we call the weighted average cost of capital. How much it costs you to raise capital to finance your business. You have loans, you have your own money, you have to have a return when you invest your own money. If you invest your own money in your business, you should expect a return. And if you calculate the average of your cost, the weighted average, because if you have more money invested from your own pockets compared to the loans, you're going to use a higher weight for your own return than the weight that you assign to interest payments when you calculate the average cost of capital. We call this the weighted average cost of capital. Okay? And if you calculate the value of the entire firm, but you don't want the value of the entire firm, you want the value only of your equity in this firm. Very easy. You calculate the value of the entire firm and you subtract the value of debt, the value of your loans. To calculate the free cash flow to the firm, we are going to use the earnings before interest and taxes. We multiply this times 1 minus TC. TC is the tax rate. To calculate the earnings before interest and taxes, after taxes, we add back depreciation. We subtract capital expenditures, investments in machines, in buildings. You subtract increase in net working capital. In this case, we're talking about investments in inventory, accounts receivable. You're going to calculate the present value of these cash flows. We're going to use some techniques here that make this calculation easier. Here on the right-hand side, have V is equal to the free cash flow at time plus 1 divided by the difference of the weighted average cost of capital minus the expected growth rate of the company. This gives you the value of the company in the future when this is a more mature company growing at a constant rate. You calculate the present value of the other cash flows as we have here in the left-hand side at the bottom of the slide in different points in time. Next month, 2 months from today, and you go until you believe that this company is going to grow at a constant rate. you add the terminal value. We call this the terminal value. That's the value of the company in the future when the company starts growing at a constant rate. And you're going to get the value of the firm today. You can do the same thing for equity. The only thing that changes here is that first, you have to subtract interest expense after tax, and you have to increase changes in debt. If you're going to use more debt to finance your business, you have to add this value to the calculation of free cash flow to equity holders. The methodology is very similar. The only thing that you see here different in these equations is that instead of the weighted average cost of capital, you have the cost of equity, because now you're not interested in the cost of debt anymore. You are analyzing only the equity part of your business. Therefore, you use the cost of equity. That's going to be the expected rate of return of your investment in the company. Right? When you invest in your company, you expect to get money back. And this is the rate of return that you expect from your company. A simple example here. We have this company, cash flow is expected to be 70,000 in 1 year, grow 10% for 2 years, then 8% for the following 2 years, and after that, you're going to have a constant growth rate of 6%. If you calculate your cash flow in year 6, that's going to be 1 year after you reach the constant growth rate stage, you're going to get $104,720. Now, using the terminal value formula that I presented in the previous slides, you're going to get that in year 5, the value of your company is going to be $1,047,220. Now, this timeline helps you to know exactly what's happening here. You have 5 years. You're going to receive cash flows at the end of each year. You're going to have $70,000 in year 1. This $70,000 is going to grow 10% in year 2. Again, 10% in year 3, 8% in year 4, and 8% in year 5. And then you have the terminal value, the value of this company in year 5 as well. If you calculate the present value of these cash flows, you're going to have the present value of your company as well. Because remember, if you calculate present values for the same period of time, you can add these cash flows. And this cash flow is going to give you the value of your firm. Okay? And in this case, here, at time 0, today, your firm is worth $767,980. This value is in thousands, right? I know that this may be a little bit complicated for those who are seeing the first time, but one of the points here is that you're going to need help to assess the value of your company, to understand how you can increase this value. You have many resources that are going to allow you to understand your business better and achieve this goal, right? To know what you can do to increase your business value. But we can conclude from this discussion that your business value depends on the cash flow that you can generate, your sales, lower costs, right? And the cost of capital. Cost of capital is how much it's going to cost you to raise capital from your own money and from other resources, from banks, federal agencies. All these costs should be taken in consideration. You have to maximize cash flows, and you have to reduce your costs. How do I maximize my cash flow? You need to understand your customers. You need to know what you can provide to your customers that nobody else is providing. You need to use all the resources that are available for you. Internet now, it's a required part of your business. You have to spend money in a smart way. You're not going to buy too much inventory, invest too much money in inventory. You have to manage your inventory. You're going to buy enough. And you have to bill your customers promptly. If you have bills to receive, you cannot keep postponing to receive this money. You need to receive as soon as you can. To minimize your cost, you need to understand the cost of capital. What's the cost of your own money invested in this business? Are there opportunities that may help you to lower the cost of that? If you have money now, you pay now. You don't let to pay later. You can get a better price if you can pay now. Technology may help you to reduce your costs. You can search for better deals if you're borrowing money. There are many lines of credit for small business that are going to provide you a lower interest rate. And as we had a question here, if your accountant should provide you these financial statements, yes. And you need to know how to read these financial statements, because you need to make sure that these financial statements are accurate. You should be your best salesperson and bookkeeper. Okay? And key points here, I know that we do not have more time, but the key points here are: focus on your financial statements. They are very important. Try to understand your clients and provide what they need when they need. Understand that you're going to have seasonal fluctuations, right? If you're selling ice cream, you're not going to sell too much ice cream in the winter. And if you have one thing that you should take from this presentation is ask professional advice. You are the person who understands your business better, but you need help. You need help from different professionals, okay? I love accounting. I try to study accounting a lot, but I don't know as much accounting as an accountant. I'm a finance professor, right? Everybody needs help, and there are plenty of opportunities out there. The Small Business Development Center provides you these resources. Just make sure that you take full advantage of them.
Thank you very much. I really appreciate it. Marcus, great presentation, very insightful. And Renee, as always, thank you so much for hosting. A couple of key quick takeaways for me. And Marcus, I really appreciate the final plug in terms of professional advice. We do have a wide range of business advisors that are in place. And I think the things that Marcus referenced with respect to increasing and improving the valuation of your business are operational challenges that we kind of work with businesses on a day-in and day-out basis. You know, Marcus referencing, you know, your accounts receivable, making sure that you're kind of doing a kind of strong efforts on this, thinking about kind of operational challenges, managing your inventory, looking at kind of best practices in terms of elsewhere in the industry. These are things that our business advisors can help with. So you strike a chord. You know, I'd certainly encourage you to take advantage and set up an appointment. The second area, you know, in terms of understanding financial statements, I always love, you know, kind of reference to that. I think the folks we work with, and this is, you know, true in our world, as obviously as in addition to the students in front of Marcus on a day-in and day-out basis, is you're kind of really and Mark has alluded to this, like you're the experts of your own business. You have a passion about your widget, whatever it may be, but the importance of understanding those financial statements is the difference between running a successful business and having a hobby. So being able to make sure that you have a sense of what those statements mean and how to be able to improve that financial condition is crucial. And again, kind of connecting with a business advisor to help you with that, I think can be kind of a good step. And then finally, I love the way Mark kind of worked through kind of the different valuation strategies and thinking about, based on some of the questions that came up as well, about what kinds of businesses may be the best fit for the different kinds of strategies that he laid out. So I think it's very clear and really effective, Marcus. So again, really appreciate your presentation, and Renee, thanks again. And I will peel off for a moment and turn the questions over. I'm quite sure there are a few over to Marcus as well. So thanks again.
Thank you. And Marcus, I lied to you. I was like, oh, there won't be too many questions. Don't worry. All right. So how does renting the space your business is affect the valuation? Renting the space your business is, I think they left out in affect the valuation. Is it based on the length of your remaining lease?
Yeah, it's a very interesting question because everything has to be thought in present value terms, right? Then if the length of your lease is going to affect the payments, this is going to affect the present value of the payments, and therefore it's going to affect the value of your business. I have a very successful friend. He has a few small businesses, and he always said that if you cannot pay your rent, you should not run your business, right? Because this is part of your business, even if you own your building. Because you should think of yourself separately. You own the building and you're using the building. The person who owns the building should receive the rent, and the person who is using the building should pay the rent. I'm the same person, yes, but you have to think about these things separately. If you can make more money renting your own building to somebody else, you should do it, okay? But the direct answer to the question is yes. The rent affects the value of the business in present value terms. If a longer lease is going to allow you to make lower rent payments, you're going to have a higher value for your business.
Thank you. We got a few questions around startup evaluation, and I will try to sum a few of them up in this question. What would be your approach to valuing a pure startup business where the seller's discretionary earnings are based solely on financial projections as opposed to historical results? And then to follow up on that a little bit, this other person's looking for the same thing to be able to prepare it in their pitch deck to present to potential investors.
Yeah, this it's a very good point because I try to make this easier to understand. But for startups, you have a longer period before you start getting positive cash flows, right? You're going to have a long period of time in which you're not going to have any cash flows. Probably you're going to have negative cash flows. You're going to be spending money, expecting to get positive cash flows sometimes in the future. It's everything based on estimations. You need to understand your business, and we have many people who understand this very well. I used to say to my students that I have a former student who is an expert on RVs. She knows everything about RVs. If you want to open a business in the RV sector, you have to talk with her. She's going to help you to estimate cash flows years from now because she knows this business very well. Then to value a startup, you need somebody who understands your business very well to help you to estimate when you're going to start getting positive cash flows. And of course, control your expenses to invest as much as you need, but not more than that before start making money, okay? Professional experts are going to help you to estimate when you're going to start getting a positive cash flow. Then you're going to calculate the present values of your expenses and your cash flows, right? The money that you invest in the business, the money that you expect to receive in the future, and that's going to determine the value of your business.
Thank you. I hope that answered a lot of the startup questions for folks. This one came in as well. This person is a single member LLC and they don't pay themselves a salary. They transfer cash as needed from the business to their personal account as needed. My accountant says it's okay. For valuating a business, is there a difference?
Yes, I have to separate the legal part from the financial analysis, okay? This is very important because I'm not a lawyer. I'm not allowed to give any legal advices. Jessica Magaldi is a very close of mine. She works with the Small Business Development Center. She is somebody who can answer questions like that. For finance, we think about the cash flow, not the legal part of who is going to receive this cash flow. We're talking about the cash flow itself, okay? And in this case, again, it's not a legal advice, only from the finance perspective. It doesn't matter if the company is receiving this cash flow or the owner is receiving this cash flow. If the cash flow is the same, the cash flow is going to be the same used in our evaluation.
This one's interesting. What about if you're evaluating for your business for the purpose of including in a will? My valuation may fluctuate over time. What about the value of good long-term SEO? I own an educational business. What about the valuation of educational materials I have created for students?
Yeah, this goes back to what I was talking about startups. It's the same issue here. You need a financial advisor who understands your business and the different perspectives that are particular to your business, right? It's something that an expert may help you, for sure. You're going to find someone who specializes in assessing the value of a company like yours. And this person is going to be able to know exactly how these different things impact your business value.
Does the entity type help affect the valuation?
Yes, it does. It does. It does affect the valuation. Would need at least another hour to discuss this topic, but it does. The short answer, yes, that it does.
All right, that will be a good follow-up one for Pace, the Pace crew. Do you have any specific advice for those who work in more volatile, less conventional fields, for example, musicians, creative folks for whom certain calculations presented today may not be as reliable?
Yes, this goes to the discussion that we had about the clientele base, right? Loyalty. If you can get a loyal clientele base, you can reduce the volatility of your business. And this, for artists, it depends a lot on the relationships that you have, not only for artists, but for artists specifically, this depends a lot on the relationships that you develop. This is part of your business. You have to be able to create good relationships, and with good relationships, you're going to have contacts, a broader clientele base, and hopefully a more loyal clientele base. I first would like to thank Andrew and Renee for this opportunity. It's a pleasure to be here talking with you. And I'm a big fan of the Small Business Development Center. I think that there are many resources there, and you should be using all of them. You should always watch these webinars, look for whatever help you can get, because nobody can construct a strong business by herself or himself. You need help, and there's plenty help available at the Small Business Development Center.
Absolutely, I appreciate that too. Andrew, what did we miss?
You all are thorough and brilliant. So all good. Marcus, again, thank you so much for a terrific session. And Renee, as always, masterfully organized and managed. So thank you.